detail into Lacerte, and then review the results on the tax forms and worksheets. I'm a CPA and senior tax analyst with Intuit. Please follow our new training forums for the latest updates, or you can click on the Resources tab to access these links and a PDF of today's presentation. Here is a list of the various use cases under ACA that I'll cover. We'll go through some basic penalty scenarios, an advanced penalty scenario, some basic credit or premium tax credit scenarios, then an advanced situation, go through a shared policy allocation example, marketplace granted exemptions, income below the filing threshold, and exemptions claimed on the return. And then, as Amy said, Don will come in and show you the interactive guide that we have for Lacerte. Okay, first off, the ACA penalty. Use case number 1, basic penalty scenario taken from IRS publication 5187. Jim, an unmarried adult with no dependents, did not have minimum essential coverage for any month during 2014 and does not qualify for a coverage exemption. For 2014, Jim's household income was $40,000 and his filing threshold is $10,150. And instead of reviewing the results here on the screen, I'll go through the results within the product. So I'm going to go out here to Lacerte, go to use case number 1, and I don't have any entries in screen 39, Affordable Care Act, because there was no coverage and no exemptions. So I'll click on Forms here and go to the worksheets. This landscape worksheet is for the penalty computation, and I'll review that with you here. So we have Jim, who's a single taxpayer. He didn't have any coverage or exemptions for the year. So on line 1, we're going to have a 1 throughout the year. And then he's 18 or over, so we'll have a 1 on line 2. And then that foots down to 1 on line 4. Multiply that by the flat dollar amount, or $95 for each of the months. And then line 6 is the sum of monthly amounts entered on line 1. That's 12. That's used for computing line 13, which is the national average premium for a bronze level plan. And that serves as a cap on the penalty. Line 7, we enter household income. For this client, it was $40,000. And then the threshold is $10,150 right out of the instructions. The net amount is $29,850. We take 1% of that because that's what the tax code says we need to do, and that results in $299. And line 11 is going to take the greater of the 1% of household income minus the threshold for the number of months not covered, and we have 12 here. It's going to be the greater of the 1% of household income minus the threshold or the flat dollar. This turned out to be 1% of household income minus the threshold was greater than the flat dollar. So what the IRS is doing here is we gross up the penalty. So we take the 1%, multiply it by the number of months that there was no coverage or exemptions, and then we divide it by 12 on line 12. And we're left with the $299. Line 13, as we said, was the cap or the national average premium for a bronze level plan. What they do is they take the number 12 from line 6 and we multiply it by a factor of $204. And that serves as the cap on the penalty. We're way under that. Our penalty for this client is $299. We go to the 1040. We go down to line 21, and that's our penalty for the year, $299. Okay, next, we're going to go to use case number 2, another basic penalty scenario. It's going to be from the IRS publication 5187, and I modified some of the inputs here just to show you the computation a little more comprehensively. So we have Eduardo and Julia, married and have 2 children under 18. They did not have minimum essential coverage for any family member for any month during 2014, and no one in the family qualifies for a coverage exemption. For 2014, their household income was $45,000, and their filing threshold is $20,300. You can review these results later on, but they're going to agree with the return, and I'll show you within product how the inputs and the outputs work. So I go to use case number 2 here. Again, we have no entries in the ACA screens because there was no coverage and no exemptions. We'll go ahead and click on the tax forms, go down to worksheets, look at this landscape worksheet. Remember, we had 4 members in the household, no coverage and no exemptions, so they get X's all throughout the grid. Total number of X's in a month, we're going to have 4 for the entire year. 2 of those members were over 18. That goes on line 2. Line 3 is 1/2 of the number of X's in a month for individuals under 18. So that for each dependent, it's going to be 1/2, total of 1 for each month. Then we total up lines 2 and 3. We're left with a 3 on line 4. Line 5, we're going to multiply that by the $95 or $285 for each month. Line 6 gets a 48. Line 7, household income, $45,000. Filing threshold, $20,300. Nets out to be $24,700. Multiply that by 1%, you're left with $247. And in this use case, the flat dollar amount is going to be greater than the 1% of household income. So we have to go down to the second worksheet here, flat dollar amount worksheet. And for each month, they want to see which is bigger, the 1% of household income or the flat dollar. In this case, the flat dollar, the $285, was greater. So we sum all those up, and we get $3,420. Again, the IRS is grossing up the number here. For each month, there's no coverage and no exemption. They multiply it by the full penalty for the year. So they're grossing it up. And then they come in on the next line here, line 12, and we divide it by 12. So we're left with $285. And that's going to be underneath the cap on line 13. And we're left with a penalty of $285. Go over to the 1040, and that's our penalty amount, $285. Okay, we'll go back to the PowerPoint here. We'll go to use case number 3, advanced penalty scenario. Took these from the Treasury regulations, and I modified the facts a little bit. In 2014, taxpayers H and J are married and file a joint return. H and J have 3 children, K, who's age 21, L, age 15, and M, age 10. H and J's household income is $47,750. H and J's applicable filing threshold, $20,300. H and J have minimum essential coverage for January through June. No other member of the family has minimum essential coverage for any month in 2014. Go back out to Lacerte here. And we'll go to case number 3. And now we do have some entries in screen 39. Let's say this household's got a 1095B, which is basically going to be a statement from the insurance company indicating whether or not there was coverage. Again, these 1095Bs are optional. You may see some, you may not. If you don't get any, you would indicate in this top miscellaneous screen whether there was coverage. So for this taxpayer and the spouse, Harry and Jane, we have coverage January through June for each of them. And then we go to click on forms, and we'll go to the worksheets, and we'll go to the top here. We're showing that Harry and Jane had coverage January through June. Then after that, there was no coverage for them, July through December. And then for the children, they didn't have any coverage or exemptions for the whole year. So line 1, we add up all the X's. And line 2, for those 18 or over, we're going to have 1s for January through June. And then we're going to have 3s for the rest of the year. That's because the taxpayer and spouse had coverage for the first 6 months. And then 1/2 the number of X's in a month for individuals under 18. 2 of the kids were under 18, so they're going to have a 1 for the whole year. We add those up and we have 2s for January through June and 4s for the rest of the year. Multiply that by the flat dollar amount, capped at $285. You're going to have $190 January through June, and then $285, the flat dollar amount cap for second half of the year. Line 6 gets a 48. Line 7, household income, $47,750. Filing threshold, $20,300. Subtract that out, $27,450. And our 1% of household income minus the threshold is $275. Then we have to go to the next worksheet because it's saying, is line 10 more than $285? So we go to the landscape worksheets, and as I said, on a monthly basis, they look at the greater of the two, the flat dollar amount or 1% of household income for each month. So for the first 6 months, 1% of household income is greater. That's the $275. And then for the last 6 months, flat dollar amount is going to be greater. That's the $285. So we add that up. We have a grand total of $3,360 for the year. We go back up to this first worksheet, and that's our grossed up number, $3,360. And we divide that by 12. We're left with $280. And we're going to be underneath the cap of $9,792. And our penalty works out to be $280. We go to the 1040, and we're left with the $280 for the penalty on line 61. So that example shows the intricacies of the worksheet, where you can have a blend of the flat dollar amount or 1% of household income above the threshold. Okay, next we'll go through some premium tax credit examples. And the first one here is use case number 4. It's going to be a basic credit scenario. And I took the facts from IRS publication 5187. We have Irvin, who is single with no dependents. He enrolled in a qualified health plan with an annual premium of $5,000. The applicable second lowest cost silver plan premium, as shown on his form 1095A, is $5,200. Irvin's 2014 household income is $28,725. I'll go back out here to case number 4 and go down to screen 39. They got a 1095A. Irvin had coverage throughout the year. We indicate that up in this screen, this part of the screen. And that basically shuts off the penalty. And then we come down to the second portion of the 1095A. And since the annual totals or the monthly totals don't change at all, we can put in the annual totals. So it's going to be $5,000 for the monthly premiums, and then for the annual premium. Then the annual amount for the second lowest cost silver plan is $5,200. Go ahead and click on forms. We go to the 8962. Family size is 1. Household income $28,725. And that represents 250% of the federal poverty level, the 11,490. Our applicable figure is 0.0805. Multiply that by line 3, and the annual contribution for health care is $2,312. Then we look at the annual calculation of the credit. As we said earlier, $5,000 for the premium amount, $5,200 for the second lowest cost silver plan. Annual contribution, $2,312. We subtract column C from B, and we have an annual maximum premium assistance of $2,888. That's underneath the cap of column A. So our annual premium tax credit allowed, $2,888. That flows down here to lines 24 and 26. We go to the 1040, scroll down, and the number becomes a payment or a refundable credit of $2,888. Okay, moving on here. Another basic credit scenario, use case number 5. Also from IRS publication 5187. Brandon Talbot, single, no dependents, and lives in Alabama. When he enrolled through the marketplace, Brandon was approved for advanced credit payments based on his projected 2014 household income of $39,095. The applicable figure for his household income is 0.095. Brandon enrolled in a qualified health plan. The applicable second lowest cost silver plan is $5,200, and Brandon's 1095A shows advanced credit payment of $1,486. Brandon's actual modified AGI for 2014 was $46,000, which is more than 400% of FPL for a family of 4. So this example points out the fact that you would have gone to the exchange and would have gotten an advanced credit payment, but then the reconciliation needs to be done at the end of the year with the true modified AGI figure. So we go to use case number 5. And we go down to screen 39, 1095A. Brandon had coverage for the full year, so it shuts off the penalty. And then the annual totals for the premiums, $5,200. Second lowest cost silver plan, also $5,200. The monthly advance is $1,486. Calculate the return. Go to the 8962. Household size is 1. Modified AGI or household income is $46,000, and that represents 401% of FPL. And in this case, you're not supposed to get any credit if you're above 400% of FPL. So the form here shuts off the penalty calculation that would have taken place, and any advances that I got have to be paid back to the government. That's the $1,486. That number flows down and there's no cap on what I need to pay back. So the full $1486 flows over to the 1040. Page 2 on line 46, excess advance premium tax credit repayments. So it gets a little tricky. That's why you want to get to the exchange during the year if income goes up so that you can adjust your advanced payment amounts or the subsidies. Otherwise, you have to pay back the full amount. Okay, next we're going to go to use case number 6, an advanced credit scenario. Pulled these out of the regulations. We have taxpayer E, claims 1 dependent, F. E is eligible for government-sponsored minimum essential coverage. E enrolls F in a qualified health plan for 2014. The exchange for E's rating area projects E's household income for 2014 to be $30,260. The annual premium for E's applicable benchmark plan is $5,200. E's monthly advance credit payment is $275. And I won't go through the math that they do there, but when you go over to the exchange at the beginning of the year, they run a projection and figure out what your advance is supposed to be. On August 1st, 2014, E loses his eligibility for government-sponsored minimum essential coverage. E enrolls in the qualified health plan that covers F for August through December 2014. The annual premium for the applicable benchmark plan is $10,000. The exchange computes E's monthly advance credit payments for the period September through December to be $675. And I won't show you the math, but you can refer to it. E's household income for 2014, $28,747. And that's what our true credit is going to be based on. So we go over to the tax product. We're going to go to use case number 6. Show you what we entered in screen 39. On the 1095B, let's say they got one of those for the government program. Edward had coverage January through July. We indicate a 1 for those months. And then we go to 1095A. We indicate the coverage that they would have had from the exchange. And then we start filling out this grid based on the 1095A. And what it's going to have is for January through July, we're going to have $433 for both the premiums as well as the second lowest cost silver plan. And we have some rounding differences down here in July. And then the advances, as we said earlier, $275 January through July. And then when Edward joined on, the numbers bumped up a little bit, so we went to $833 for August through December for the monthly premiums and the second lowest cost silver plan. The monthly advances jumped up to $675 for August through the end of the year. And here are the grand total, $7,200 for the premiums and second lowest cost silver plan and $5,300 for the advances. Click on forms, 8962, family of 2, modified AGI 28,747 is 185% of AFPL. The annual contribution, 1,613 or 134 per month. Then we come down to the grid. The monthly premiums and the second lowest cost silver plan, $433 January through July, and then $833 for the rest of the year with a couple of rounding differences. Monthly contribution amount, $134, comes from line 8B. Monthly premium assistance, we're going to subtract 134 from the 433. We're left with 299. That's underneath the cap in column A. So our monthly premium tax credit allowed is going to be $299 through July, and then it bumps up to $699 through the end of the year with some rounding differences. Monthly advances $275 through July, and then $675 for the rest of the year. The grand totals, line 24, total of the premium tax credit, $5,592. Advances, $5,300. Net premium tax credit that this taxpayer is owed is $292. So he goes to the front of the tax return, page 2, and that's where the $292 comes in. Gets an extra credit. Okay, next we're going to go to use case number 7, shared policy allocation. This example came out of the regulations as well. We have taxpayers V and W, married and have 2 dependents. In 2013, the exchange for the rating area where the family resides determines that their 2014 household income will be $76,000. V and W enroll in a qualified health plan for 2014. The premium for the applicable benchmark plan is $14,100. The exchange approves advance credit payments of $573 per month. V and W on June 17, 2014, they get divorced and obtain separate qualified health plans beginning July 1st, 2014. V enrolls based on household income of $60,000 and a family size of 3. The premium for the applicable benchmark plan is $10,000. The exchange approves advance credit payments of $358 per month. Because V and W do not agree on an allocation, V and W must equally allocate the benchmark plan premium, $7,050, and the advance credit payments, $3,438, for the 6-month period, January through June, when they are married and enrolled in the same qualified health plan. Thus, V and W are each allocated $3,525 of the benchmark plan premium and $1,719 of the advance credit payments for January through June. V reports on 2014 tax return $60,000 in household income and a family size of 3. And I'm only going to show you V's tax return. W is going to work the same way. So we go to the tax product, and I'm going to go down to case number 7 here. Go down to screen 39. We got a 1095A. We have Vincent, Arnold, and Bonnie covered for the full year from the exchange. For January through June, the monthly premiums and the second lowest cost silver plan, the grossed up figure, because it would have included the former wife, $1,175. And then the grossed up, or the full amount of the monthly advances, $573, January through June. But then just for these 3 taxpayers and dependents, it moved down to $833 for the monthly premiums and the second lowest cost silver plan for July through the end of the year. And then the advances moved down to $358 for the second half of the year. We come down to the shared policy allocation in Part 4. Here, the government form wants the former spouse's SSN. Punch that in here. And then the allocation, January through June. We're going to say this taxpayer had 50% for the premium, second lowest cost silver plan, and the premium tax credit. Okay, we click on Forms, and we go to the 8962. Family size within this household is 3. Household income, This is what his tax return would be showing at the end of the year. Just him and the 2 dependents. So $60,000 represents 307% of FPL. Annual contribution is going to be $5,700 for the year, or $475 per month. Come down to the monthly grid. First, we'll go to part 2 here, and it's going to be 50%, as we said earlier, for the premiums, benchmark plan, and the advances, January through June. So the product's going to take that percentage and multiply it by the figures that were on the 1095 for the first half of the year. And for the monthly premiums and the benchmark, it's going to be $588. The net figures for January through June, and then no allocation for the second half of the year. It's going to be $833 for the monthly premiums and the benchmark figure. $475 in column C. That comes from right up on line 8B. We subtract C from B, and we're left with $113 for the first half of the year, and then $358 for the second half of the year. Column E is going to be underneath the cap that we have in column A. So this is our monthly premium tax credit allowed. The monthly advances, the net figure after the shared allocation percentage, $287 for the first half of the year, and then the gross numbers that didn't need to be netted, $358 for the second half of the year. Grand totals, total premium tax credit, $2828 from column E. The advances, the total is $3,870. That's going to be the total from column F. What's it net out to be? The excess advance payments are going to be $1,042. That's because the advances turned out to be greater than the premium, so we have an excess advance payment which needs to be paid back. It's underneath the cap of $1,250. So that full $1,042 needs to be paid back to the government by this taxpayer. We go to page 2, and we have the $1,042 gets added into our tax. Okay, now we're going to go through 3 of the different exemption types that you'll encounter on the return. There's many different subgroups of exemptions, but in the larger basket, we're going to have marketplace granted exemptions, exemptions computed on the return, and then exemptions physically claimed on the return. In this section, we'll talk about those 3. So use case number 8, marketplace granted exemptions. The following exemptions can only be granted by the marketplace and cannot be claimed on the return. Members of certain religious sects, determined ineligible for Medicaid in a state that did not expand Medicaid, general hardship exemptions, coverage considered unaffordable based on projected income, unable to renew existing coverage, and AmeriCorps coverage. However, marketplace granted exemptions do need to be reported on the tax return. So they're not physically claimed on the return, granted by the marketplace, but you still need to report them on the return. And you can refer to Form 8965 instructions for the full list of exemptions. The ones listed here can only be granted by the marketplace. And to show you how those work in product, we'll go to use case number 8. We'll go down to screen 39. And these are pretty straightforward. Go down to this section here, marketplace granted exemptions. We punch in Edward and Pamela taxpayer, their SSNs, and then they would have gotten an exemption certificate number from the marketplace. And we punch that in here. The exemption start months and the ending months. We're saying they had them for the full year. So pretty straightforward. Click on Forms. We go to the 8965, and that's where we're going to report those exemptions in Part 1. And then we go to the worksheets, and there's no penalty worksheet. It would have been shut off here. Nothing comes in on line 61. No penalty since there were exemptions for the full year. Okay, next we go to use case number 9, the exemption for income below the filing threshold. If you're not required to file a tax return and do not wish to file a return, your tax household is exempt from the shared responsibility payment, and you don't need to file a return or do anything else to claim the coverage exemption. If your gross income is less than your filing threshold, but you file a tax return for any reason, you're going to use Form 8965 Part 2. And this is automatically calculated by the software. Go back out to Lacerte here. And we're going to go to use case number 9. Wages are $20,000. Click on, we didn't punch anything into screen 39, wasn't necessary here. We go to 8965, scan down to Part 2. Are you claiming an exemption because household income below the threshold? Yes. Gross income below the threshold? Yes. Nothing else is needed. 8965 needs to be attached. If they do file the return, and the penalty gets shut off. Moving on, we have the last use case here, number 10, exemptions physically claimed on the return. We're going to use a pick list for most exemptions. The short coverage gap exemption is automated within the product. That's where you have less than or equal to 2 months of no coverage or other exemptions. And you can have only one gap for the year. We'll go out to Lacerte once again. Go to use case number 10. Go down to screen 39. And what we have here is Edward has coverage March through December. So that's where this first section comes in. Edward, March through the end of the year. So we had a short coverage gap, January and February. And then we go down to this other section here to indicate exemptions that we want to claim on the return. And the ones you're going to have are coverage considered unaffordable, citizens living abroad and certain non-citizens, members of a healthcare sharing ministry, members of Indian tribes, incarceration, aggregate self-only coverage considered unaffordable, gap in the coverage at the beginning of 2014, gap in CHIP coverage, resident of a state that did not expand Medicaid, limited benefit Medicaid and TRICARE programs that are not minimum essential coverage, and lastly, employer coverage with non-calendar plan year beginning in 2013. So the spouse had the first type for the entire year. Or, I'm sorry, January through June only. We click on Forms. We go to the 8965. Nothing in the marketplace granted exemptions. Household income, gross income above the filing threshold. Then we had Edward. He's claiming a short coverage gap, January through February, and he had coverage the rest of the year. So he's exempt for the first 2 months. Pamela, we said she's claiming an exemption for January through June. We go to worksheets, click on the penalty worksheet. Edward gets hit with no penalty because he had a short coverage gap and he had coverage for the rest of the year. Pamela, she had an exemption only January through June, but no coverage, no exemptions for the rest of the year. Consequently, she's going to get hit with that penalty for the second half of the year. That turns out to be 149. I won't run through the numbers again, but we go up to the 1040, and that's where the 149 comes in. Okay, so that is going to be it for the use cases. And then I'm just going to splash on the screen here, as I did in the prior presentation, ACA online resources. We have a website for tax professionals devoted to ACA. Then we have a Lacerte and Pro Series interactive guide. IRS website explains the tax provisions around ACA. And then also you can go out to healthcare.gov, Small Business Administration, and Department of Labor for additional information. Okay, now I'm going to hand off to Dawn, who's going to go through our interactive guide. And then after that, we'll do questions and answers.
Hey, Mike, while Dawn's getting all set up, I'll just go over some of the questions that have come on. And Dawn, you should be set up as presenter. But Phoebe had a couple questions. On the last example that we did, we used January through February. But there is, she mentions that there's a special January through March exemption for 2014 only. So maybe that the example should cover middle months instead.
Yeah, that's a good question. It's called out as a separate exemption. And that, if you look in the 8965, we don't have that automated yet in the product. I'm not sure if we're going to address that, but you can use the pick list to grab that exemption. But she is right. There are two different coverage gaps. One of them is just for short coverage any 2 months of the year. And then there is another one, a special provision for 2014 that is from the 8965 instructions.
Okay.
Thank you for pointing that out.
All right. Well, before we go to any other questions, it seems like Don is ready, so he's going to go ahead and go over quickly the interactive guide that we have available.
Thanks a lot, Amy. Thanks, everyone. My name is Don Malooly. I'm a Senior Supportability Specialist with Lacerte Tax in our Knowledge and Care Department. And we have around the Affordable Care Act, we've developed a Lacerte and Pro Series interactive guide. It is accessible within the product. You can go to any of the in-product links for Screen 39 and access the guide there. What you'll see here is ACA Interactive is what we've done is to aggregate all the information. A lot of this information is from various sources, healthcare.gov, irs.gov, and aggregate it in an interview type format so that it can be used as a reference for you as preparers, both by yourselves and in front of your clients. So we start out with the provisions of the Affordable Care Act, some of the highlights around reporting, around the elements of the diligence requirements and the fact that oral testimony can be used, and we've provided links for IRS best practices around 8965 and 8962. As Mike mentioned, the 1095A is mandated this year. 1095B and C are optional. So the guide is designed to, again, aggregate this information, just provide that quick access to the content. We go then, jump right into the 8962 and 65, which are elements of the Lacerte program. We also here provide a link to the Understanding Affordable Care Act website, which is a great source for content as well. Where you see this bubble, if you hover over that, you're going to see additional help, and that's embedded throughout the guide here. So let's jump right in. The interactive guide is structured around fundamental concepts around eligibility, coverage, exemption, or penalty. So it's basically designed to help you determine who's eligible or who's under the provisions of the Affordable Care Act. And so for this, we've put together links defining who is eligible for this, who's mandated, and again, the reference points of the guide point back to primary sources. So to assist you with clients who may, well, where did you find that, or where is that from? This just gives you that additional direct, quick access to that information, again, from Health and Human Services, IRS, different sources. So let's jump right in. A lot of these are in a yes-no format. So if we have a situation where, say there was no, it goes very quickly to ineligible for the provisions of the coverage. So within this, we move from eligibility to coverage. So there's some primary divisions here around employer or job-based insurance, around marketplace insurance, 1095A, health insurance directly purchased outside of the marketplace, and then government-issued health coverage. So let's take, say, the first one, job-based insurance. It reiterates that this satisfies the minimum essential coverage required by the provisions of the Act. We provide detailed links here, as well as a reference to grandfathered plans. So let me just show a basic division here is if you had coverage throughout the year, very simple for all members of the household. This is the input that you would put in screen 39.1. As mentioned, because it's not marketplace insurance, there's no 89, 65, or 62 required in this situation. If it was not all months, then there'd be a situation where you have to account for months where there was no coverage or obtain an exemption. So you'll see some input screens here. We try to be very visual and provide you direct access points to the product just to give you a guide here. So going through, as Mike touched on, obviously the program does these calculations automatically, but this provides a couple of base scenarios where you can go through and see a line-by-line explanation of that. Then we could directly go, so if the household did not have coverage all of the year, we want to then provide all the exemption options that are available to you. So as touched upon, there's marketplace granted options as well as directly reported on the, or directly claimed on the return. So this provides you a pathway for each of those categories. And so let's say in this where it's below the filing threshold, there's a, this is showing that area part 2 there, and that's automatically calculated by the program. Let's say go to healthcare sharing ministry. You'll have an option here to indicate were they or were they not part of the of that healthcare sharing ministry. This is an example where there's actually 2 ways in which it can be claimed. It can be claimed directly on the return, or as Mike said, when you get a marketplace granted exemption, you report it on the return. In this case, each and every point where there's a marketplace granted option, we provide a link to you to the CMS site where you can print out the application, hand it to your client, they can then fill out the paperwork. So again, trying to aggregate the information and present it as convenient manner as possible. This is comprehensive of all the options that are available to you, again, whether they're marketplace or claimed directly on the return. And again, these bubbles provide a little hover over capability to give you additional information. Going back to the tree, let's take another path. So say we had a government-issued software, I'm sorry, healthcare. So where we have here an option, again, a lot of this input's very simple if a 1095A was not received. Let's go directly to the marketplace where we have a 1095A. So again, here's some information to provide for your client and for you to refer to. And if you indeed are able to enter this, this provides articles which you can then refer to that shows screenshots in the program for areas to enter the information. And again, frequently asked question around 8962, where we've gotten a lot of views. Overall, we've got some very good usage of the guide, which you've seen. And again, we look here for various scenarios that we can incorporate into this. And again, to provide you a resource that you can use. So jumping one area back to the end there, where we have all the exemptions, we show it either comprehensively at one time, or you have the option to go through each of the exemptions sequentially. We believe in most instances as a professional preparer, you're going to give me the whole menu of choices, I'll look through it. And then if none of the exemptions apply, then there's the penalty provision. And so again, this shows the greater the 1% or the 285. So that's kind of a whirlwind tour of ACA Interactive.
Thanks a lot, Don. I'm going to go
You
ahead
bet.
and stop the recording.